Erin Browne of Pimco writing the following. Recent macro data and earnings reports indicate a US economy that continues to outpace other developed markets. We maintain an equity overweight concentrated in the United States. Erin joins us now for more. Erin, welcome to the programme. Let's start with that. And let's start more broadly as well with just some of the consensus positions coming into 25. We've upended a series of them. US versus Europe, for the dollar bulls, for the bond bears. There's been plenty to think about. Do you think they're just position squeezing or something else, something more?
I do. I mean, I think that, coming into this year, the markets were, broadly speaking, pretty long dollar, short bonds, and long equities, but long probably U.S. equities over the rest of the world. And really, none of those trades have panned out. Europe has outperformed the U.S. Bonds have basically gone nowhere, and similarly with the dollar. I think a lot of that is just a little bit of position squeezes going into what was, fairly crowded positioning in the beginning of the year. But when you step back, I see very little reason for the rest of the world to outperform the U.S., particularly under the Trump administration's policies that they're pursuing. But also, if you just look at growth dynamics and inflation dynamics across the world, the U.S. is clearly continuing to outpace and outperform the rest of the world, which, really would give way to the U.S. equity market outperforming the rest of the world as well. And, while certainly the Fed has paused relative to other central banks, what you're seeing now is probably more fiscal out of the U.S., which ultimately is what is going to drive the economy more so than central bank rate cuts at this point, at this point of where we are. So I think that the U.S. is still, front and center, the main outperformer within U.S. equity markets. And I think that U.S. domestics particularly are what's going to outperform this year.
So Mislav Matejka over at JP Morgan in Europe, Erin, made a similar point, that for this trade to work the way it has been working over the past few weeks, you need to close growth differentials, and there's no sign of that happening just yet, which takes us back to the US and your call. So let's sit on the US equity market and think about what's working, banks, what's not, certain parts of tech. What do you think will work in the year ahead and why?
So I think staying as domestic as possible is going to work. So financials, I think, are going to continue to be an outperformer this year. Also, the power utility names, particularly those that are leveraged to the AI trade, I think those names still work. Clearly, they took a little bit of a breather in the beginning of the year and late last year, but I think that position is actually really attractive to re-enter right now. I also think that some U.S. cyclicals, consumer cyclicals, will work, but I, really stay away from any cyclicals that have international exposure. Energy sector, I also think, is going to do quite well this year. What won't work? Industrials continue to forestall any type of CapEx investment. They've now pushed it out another 2 quarters to the end of this year. Business CapEx is underperforming relative to, or business sentiment, rather, is underperforming relative to consumer sentiment. And so I think that, what anything with international exposure that is going to be front and center with respect to tariffs is likely going to underperform. And some of the more deep cyclical materials, mining, industrial sectors are likely in that bucket, whereas the ones that are more leveraged to the consumer are likely the ones that are going to outperform this year.